Hey everyone, Scott here, and this week we're talking about market volatility and what that can mean to your retirement plan. So we're going to talk about the difference between volatility and risk. We're going to talk about how different investments, how their risk level and their volatility can be different and how that can affect a retirement portfolio. And stay to the end because we're going to show you in real numbers what a well-diversified good investment plan can look like for a retirement portfolio. So let's jump right into it. What is the difference between volatility and risk? So let's think about this in terms of two different types of investments. Let's go with the stock market. Okay, the stock market is volatile, right? Volatility is just a measure of how much does it fluctuate, okay? Whether that's from a day-to-day basis, year-to-year basis, how much does an investment fluctuate? So that's volatility. Risk is what's your chance that you're going to lose that investment. So let's talk about the stock market and how risky it is versus another type of investment, which is, let's say, a restaurant in the middle of New York City. Which investment do you think is more risky? A restaurant in the middle of New York City or a bucket of stock market investments? Probably the restaurant, okay? But which one is more volatile, okay? The stock market is more volatile because it fluctuates on a day-to-day basis. Every single day, there's a new value. We got to watch those prices go up and down. Whereas the value of the restaurant, it pretty much stays the same every time the owner of that restaurant marks it down on his balance sheet. He might change it once a year, but no one would argue that a restaurant in the middle of New York City is less risky than the stock market. So that's the difference between volatility and risk. So now let's look at some examples of less extreme investments and how they look like when you plug in risk and volatility. Let's jump into that. Okay, so let's get into it. This is a program that measures risk and volatility on different investments. And so it measures between 1 and 100. 1 being no risk at all, 100 being, well, actually 99 being the riskiest an investment can be. And so we're going to look at how different investments look with certain risk numbers. And also we're going to look at the fluctuation that certain investments can expect over the next 6 months to a year. So the first one I wanted to look at, now I want to be clear, I am not making an investment recommendation here. I just wanted to think of, hey, what's a really volatile investment that's been in the news a lot lately? And that would be Tesla Motors. So this is Tesla stock. So Tesla is about as risky as it gets. It is a 99 on the risk scale. And it is very, very volatile. So let's pretend that you decided you love Tesla and you're going to put 100% of your $1 million retirement portfolio into Tesla stock. Well, historically, you would say, based on historic performance, you would have you'd have a 95% chance that your returns over the next 6 months would fall somewhere in this spectrum. So your portfolio could be down as much as 85%, or it could be up as much as 94%. I like being up 94%, but I really don't like being down 85%. So let's put that in dollar terms. If you got $1 million and you're down 85% over the next 6 months, that's $852,000. Now, some of you might be able to stand that volatility. I don't think I could stand that volatility personally, and that's just where we got to get a little bit more conservative. Now, one thing I'm going to point out, the more risk you take, the more potential return. So this is saying that you have a potential annual return of 8.66%. So we'll kind of refer back to that as we go through. So let's look at a very conservative option. If this was a very risky, very volatile option, let's look at a conservative and not volatile option. This is cash. All right, so let's just pretend you put all your money in cash, took no risk whatsoever. It's a 1 on the scale. Not very volatile, right? Cash doesn't jump up and down in value at all. But the return you're going to get is pretty much nothing. So I think this is probably being pretty optimistic, saying that you have a 95% chance to fall somewhere between 0 and 0.42% in return. I think we'd all be decently happy to get 0.42% on our cash, but I mean, that right there, that proves to you can't just have your $1 million retirement, or not many people can afford to just have their $1 million retirement earning $4,200 over the course of 6 months. It's just not going to get it done. So now you might be saying, okay, well, maybe owning one stock doesn't make sense, but what if I diversify? What if I just own all of the stocks? You know, I get as diversified as you can get inside the stock market. There's actually a fund for that. It's the Vanguard Total Stock Market Fund. So that's what this is. This is all of the United States stock market, and it's saying that the risk number on that is an 82. And the downside over the next 6 months is about 18%, or $188,000. And the upside is a pretty nice 25% over the next 6 months. And the potential annual return is 6.87% if you just own the entire stock market. So very diversified, but 100% in the stock market. And, you know, this is still pretty volatile. If you have $1 million portfolio in retirement and you need to be pulling money off of your account every single month, or maybe you just take it out once a year, and let's say timing is bad for you and you get unlucky and the market's down 19%, well, you still got to pull that money out. You'll be selling your stocks, you'll be selling your fund while everything's down at the discount. And so to me, this is still a little bit too risky, a little bit too volatile for someone in retirement. Now, that's not always the case for everyone, but this is still pretty volatile. So now we're going to look at just kind of an average client. Now, this isn't an actual client's portfolio, but this is just a mix of investments that we use. And to get that client a nice 50-50 risk score, nice and safe, not in cash, but in something that's going to get us some sort of return. And as you can see, the risk number comes down to 50. The downside is still there. There's still some downside. Anytime we're in the stock market, we're going to have some downside risk, but it's only 9.5% now compared to if you're 100% in the stock market, it was 18%. And if you were in Tesla, it was 85%. So 9.5 doesn't feel so bad. I think we might be able to handle that. Also, a pretty nice 15% potential return on the upside, but overall, potential annual return of 6%. We like to see that because that was, remember, the stock market in total was 6.87. Here we're taking a lot less risk, dealing with a lot less volatility, okay, a lot less volatility, and getting almost the same return. So this is what a good, well-balanced investment plan should look like versus, you know, just going all in on Tesla stock or GameStop or, you know, one of the super risky stocks that's out there. All right, well, I hope you enjoyed this video on market volatility. I hope it brought some clarity on how volatility can affect your retirement, how the difference between volatility and risk. I hope it brought some clarity for you. But if you don't have a plan in place, if you don't know how you're going to handle volatility, go check us out, carlsonfinancial.com. Give us a call, 844-CARLSON. Set an appointment with an advisor. Come in, get that investment plan in place now while things are going well in the market. Don't wait until the market's at, you know, in a free fall to go get that investment plan in place. It's important to take some action now. So go to our website, carlsonfinancial.com. If you just want to see some past videos, you want to see some of the more information we go over, go up to Carl's Corner. You can see all of our past videos, a lot of topics that are important to your retirement. So until next time, have a great rest of your day, and we will see you later.